Hey everyone, welcome back to Corporate Decoder, the place where we decode the business world one document at a time. Today we're diving into a massive deal that could reshape the entertainment landscape, and it involves your favorite streaming giant and a name that used to be synonymous with cable. So Netflix Incorporated has just filed a Form 8K, which is basically a report for big important events. And folks, this one is a doozy. It announces that Netflix is acquiring Warner Bros. Discovery Incorporated, yes, you heard that right, the house of HBO, DC Comics, and all those classic Warner Bros. Movies is now potentially going to be part of Netflix. Let's break down what this means. Netflix, the streaming powerhouse, is teaming up with Warner Bros. Discovery, the company that combines Warner Media and Discovery. This is a colossal merger and the paperwork spells out all the nitty-gritty details. At its heart, this filing is about an agreement, a plan for a merger. Netflix, through a subsidiary called Nightingale Sub Incorporated, is set to acquire Warner Bros. Discovery, or WBD as it is commonly known, but it is not as simple as just 1 plus 1. There is a bit of a dance happening before the main event. Scrollspiration and distribution center before the big merger, WBD is going to do some house cleaning. They're going to split off their global linear networks business, essentially their traditional cable channels, into a new company called Spinco. This means WBD, the part that Netflix is really interested in, will be focused on its streaming and studio businesses. Think of it like WBD shedding some weight to become more attractive to Netflix. They'll then distribute the shares of this new Spinco to their existing shareholders. Scroll effect on Capital Stock Center now for how the numbers work. When this merger officially closes, each share of WBD common stock will be converted into a combination of cash and Netflix stock. The cash part is set at $23.25 per S-share. The stock part, however, is a bit fluid. It depends on the average trading price of Netflix stock, or what they call buyer common stock, for a specific period leading up to the closing date. This ensures that the deal remains fair for both sides as market conditions shift. Scroll treatment of equity awards C-Center. What about the folks who work for these companies and have stock options or restricted stock units? The agreement clearly lays out how these equity awards will be handled. For vested options, they will be cancelled and converted into a right to receive the merger consideration. Unvested options will be assumed by Netflix and converted into a cash payment, but this payment will still be subject to the same vesting conditions as the original options. It is a way to ensure that employees who remain with the combined company are rewarded, while those leaving might still get something depending on their vested status. This is pretty standard in big buyouts to retain talent. Scroll presentation and warranties. Certain covenants C-Center like any major deal. There are promises and rules. The agreement includes standard representations and warranties. Basically promises that both companies are telling the truth about their businesses and financial health. There are also covenants, which are agreements to do or not do certain things. For example, WBD agrees to run its retained business, those streaming and studio operations, in the ordinary course of business and not to solicit other offers. Netflix also has its own set of covenants. Scroll prior to the adoption of the merger agreement by WBD's stockholders C-Center. This part is interesting. The board of directors at WBD can change their recommendation to their stockholders about approving this deal, but only under specific circumstances. If they receive a better unsolicited offer, known as a superior proposal, they might switch gears. However, they have to follow a strict process, give Netflix a chance to match the offer, and potentially pay a significant termination fee. This is to prevent WBD from easily backing out of the deal. Scroll closing conditions center. So what needs to happen for this deal to be finalized? A bunch of things. First, the separation and distribution of Spinco must be completed. Second, WBD's stockholders need to vote and approve the merger. Third, Netflix's stock being issued needs to be approved for listing on the NASDAQ exchange, and a registration statement needs to be effective. Fourth, all necessary antitrust approvals like the Hart-Scott-Rodino review need to be secured. And finally, there should be no laws or orders preventing the merger. Both Netflix and WBD also have to make sure their representations and warranties remain accurate, and that they haven't experienced any major negative changes to their businesses. Scroll financing iCenter now. Let's talk money. This is a massive acquisition, and it is going to cost a pretty penny. Netflix has secured commitment letters for up to a staggering $59 billion in senior unsecured bridge term loans. This massive amount is intended to finance the cash portion of the purchase price, cover fees and costs, and potentially refinance some existing debt. It is a huge sum, but it underscores the scale of this transaction. Importantly, The filing states that securing this financing is not a condition to Netflix's obligation to complete the merger, meaning Netflix has to go through with it even if they hit some snags with the loan. Scroll termination rights and fee center. What happens if things go south? The agreement outlines how either party can terminate the deal. This can happen by mutual agreement if WBD stockholders don't approve it, if a court issues a permanent order against it, or if the deal doesn't close by a specific date, the 4th of March 2027. With possible extensions, there are also specific termination rights for each party. For instance, Netflix can terminate if WBD breaches its covenants, or if WBD's board changes its recommendation. WBD can terminate if Netflix breaches its covenants, or if they decide to accept a superior proposal. Scroll Company Termination Fee Center. And if a termination happens under certain conditions, there is a fee. If WBD walks away to pursue a superior offer, or if their board changes its recommendation and the deal ultimately fails, WBD might have to pay Netflix a fee of $2.8 billion. That is a hefty penalty for breaking the engagement. On the flip side, if Netflix can't get the deal done due to antitrust issues or foreign regulatory laws, Netflix might have to pay WBD a fee of $5.8 billion. It is a way to compensate the other party for wasted time and effort. Scroll description of merger not complete tie center. The filing also reminds us that this summary is not the entire story. The full agreement, attached as an exhibit, contains all the legal protections and specifics. They also throw in a standard disclaimer that the agreement is for informational purposes and shouldn't be taken as a guarantee of future events, as the actual situation might change. Scrollatum 7.01 Regulation FD Disclosure She Center. To go along with this filing, Netflix and WBD released a joint press release on the 5th of December. 2025, announcing the deal. They also mentioned an investor conference call to discuss the details. This is all about making sure the public and investors are informed simultaneously. Scroll important information and where to find it. I center this section is crucial for anyone who wants to dig deeper or is a shareholder. It tells you that Netflix will be filing a registration statement that includes a prospectus and a proxy statement for WBD shareholders. They urge investors to read these documents carefully because they will contain vital information about the merger. They also provide website links where you can get these documents for free. Scroll participants in the Solicitation Center. This part outlines who might be considered participants in soliciting votes for the merger. It is standard language to make sure everyone involved in promoting the deal is properly identified, and it points to where you can find more information about Netflix's and WBD's directors and executive officers. Scroll Offer or Solicitation Center. This is a legal disclaimer stating that this communication is not an offer to sell or a solicitation to buy any securities. It is purely informational and not an attempt to convince anyone to invest based on this announcement. Alone, scroll Cautionary Statement regarding forward. Looking Statements C Center, and finally the forward-looking statements. This is where they talk about potential future outcomes, risks, and uncertainties. They warn that actual results could differ materially from what is stated due to various factors like regulatory approvals, integration challenges, and general economic conditions. They're essentially saying, we're hopeful, but there are a lot of moving parts that could affect the final outcome. So, what is my take on all of this? This is a monumental deal. Netflix, by acquiring Warner Bros., Discovery's core content and streaming assets, is making a massive play to become an even bigger dominant force in entertainment. The separation of the linear television business is smart, allowing Netflix to focus on what it does best, which is digital streaming. The financial commitment here is enormous. $59 billion in financing is huge. This shows Netflix's ambition, but also how much they are leveraging themselves to make this happen. The cash and stock mix for WBD shareholders provides some certainty with the cash component and also a stake in the future of a supercharged Netflix. The risks are significant though. Integrating two massive companies is incredibly complex. There are regulatory hurdles, potential antitrust concerns that could scuttle the deal or force concessions, and the challenge of blending two different company cultures and talent pools. The downside protection with those termination fees shows just how serious both parties are about getting this done, but also the potential for costly breakups. Overall, this merger signals are bold. Aggressive strategy from Netflix to consolidate power in the streaming wars. If they can pull it off smoothly, they could unlock massive synergies and new revenue streams. But the path ahead is fraught with challenges. It is a high stakes gamble that could either cement Netflix's legacy or create unforeseen problems. Alright, that is our deep dive into Netflix's colossal acquisition plan. What is your take on this potential merger? Do you think it is a game changer or a risky bet? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps, and subscribe for more corporate breakdowns. Don't forget to check out the Discord link in the description to join our community discussions. Thanks for watching. See you next time.